Welcome to Part 5 of our Chapter 2 lecture series. Learning Objective, Prepare and Explain the Use of a Trial Balance. Preparing the trial balance involves 3 steps. 1, we have to list each account title and its amount from the ledger in the trial balance. If an account has a 0 balance, list it with a 0 in the normal column balance or omit it entirely. In the real world, we don't put 0 balances in a trial balance. The software will ask for it, but in the real world, know that we don't. Compute the total of debit balances and the total of credit balances. Verify proof total balances equal total credit balances. The total of a debit balance equals the total of credit balance for the trial balance. However, equity of these two totals does not always guarantee that no errors were made. If I left something out, it could still balance. If I put something in twice, it could still balance. The total of debit balances equals the total of credit balance for the trial balances showed in this slide. Equity of these two totals does not guarantee that no errors were made. For example, the column totals will still be equal when a debit or credit of a correct amount is made to the wrong account. Another error does not cause unequal column totals occurs when debits and credits of an incorrect amount are entered. And like I said before, it is entered twice correctly or omitted altogether. Please understand that this trial balance is a tool for the accountant. No one sees it but them. They're looking to check their work. So when we're searching for errors, if the trial balance doesn't balance, the errors have to be found and corrected. We verify that the trial balance columns are correctly added. We're taking numbers from each of the ledger accounts and putting them into the trial balance in order, putting the debit balances on the debit side and the credit balances on the credit side. Again, these are done in account number order, so you're not going to see all the debits on one side and in order, and then everybody puts in the credits on the other side. That is only for a journal entry. It's not for the balance sheet. We verify that account balances are accurately entered from the ledger. We see whether a debit or credit balance is mistakenly listed in the trial balance as a debit or credit. We recompute each account balance in the ledger. We verify that each journal entry is properly posted. Verify that the original journal entry has equal debits and credits. We then prepare financial statements from these business transactions. As we've seen in the last chapter, after the trial balance has been prepared, we begin preparing the financial statements. We always begin with the income statement because net income from the income statement appears on the statement of retained earnings. After the income statement, we prepare the statement of retained earnings because the ending balance in retained earning appears on the balance sheet. Next, we prepare the balance sheet and finally the statement of cash flows. This is another side that we had seen before. These are the 4 financial statements and their purposes. Income statement reports revenues less expenses along with resulting net income or loss over the period of time due to earning activities. Statement of retained earnings reports how equity changes over the reporting period from net income or loss or from any dividends over the period of time. The balance sheet reports the financial position, types and amounts of assets, liabilities, and equity at a point in time. The statement of cash flow lists the cash flows, inflows, and outflows for the period. They're not showing the cash flows for Fast Forward in this particular lecture, but they're returned to this statement in the next chapter. This is our income statement. This is for December, for the month. Information about the revenues and expenses is conveniently taken from the trial balance. Net income of $3,395 is reported at the bottom of the statement. Owner's investments and withdrawal are not a part of net income. Fast Forward statement of retained earnings is the second report on this slide. It shows the beginning balance of 0, brand new company when you see that beginning balance 0, plus the $3,395 of net income. We had $200 of dividends that we have to subtract out for $3,195 into period retained earning balance. The beginning balance in the statement again is 0, an exception for the first period of operations. So you'll only see it when the company is brand new. And beginning retained earnings balance is now $3,195, which is going to go to the balance sheet. This balance sheet shows the financial condition at the close of business on December 31st. Left side of the balance sheet lists all the assets. Cash, supplies, prepaid insurance, and equipment. The upper right-hand side of the balance shows that it owes $6,200 to creditors and $3,000 was received for service in advance. The equity section shows equity of $32,195. That's $30,000 of common stock plus the ending retained earnings from the statement of retained earnings at $3,195. Note the link between the ending balance of the statement of retained earnings and the capital balance. So this retained earnings is brought forward to here. We would not use the retained earnings that we find in the ledger at this time. We will be changing that during closing. Presentation issue. Because we're doing this all online, there's things that we need to learn. And say we're trying out for a job and they make us do journal entries by hand, which is a common test that they may make you do. Here are many common standards. Dollar signs are not used in the journals and ledgers. The only thing I put into these journals and ledgers is money, so I don't have to designate the dollar sign. They do appear in the financial statements and other reports such as trial balances. The usual practice is to put dollar signs beside only the first and last numbers in the column. When accounts are entered in the journal ledger or the trial balance, commas are optional to indicate millions, thousands, and so forth. I would prefer they be standard just because it's an easier read. Commas are always used in the financial state. Companies commonly round amounts and reports to the nearest dollar, even to a higher level. Just keep those in mind should you have to prepare a journal entry or whatever, say they give you a written test, and I've had it done. So just be aware of that. We're going to prepare a trial balance for Apple using the following condensed data from its fiscal year end of September 26th of 15. Trial balance lists every account from the general ledger with its balance either debit or credit. The accounts again are listed in financial statement order based on their numbering in the chart of accounts. Assets are listed first. Assets have a normal balances of a debit. They sit on the left-hand side of the equation. Next, we list the liabilities. Liabilities have a normal balance of a credit. They sit on the right-hand side of the equation. Then we follow with subsets of equity. The common stock account has a normal balance of credit. Investments to equity. Dividends, payments to the owners decrease equity, therefore they have a normal balance of a debit, and revenues increase equity, so normal balance of a credit. And finally, expenses, normal balance of a debit as they decrease equity. The trial balance proves that the total of debits equals the total credit. Apple has 4 different assets. All assets have normal balances. Cash, $21,120. Accounts receivable, $16,849. Land and equipment, $22,741, and investments and other assets, $230,039. They're listed in what we call the order of liquidity. So the order you see with starting with cash, how quickly can these be turned into cash? Cash is the most liquid. Accounts receivable, land and investments comes towards the end. Accounts payable, other liabilities or credits, we have the $35,490, the $135,634, capital stock, $27,071, retained earnings beginning of the year, $87,152, dividends, revenues, cost of sales, expenses, and we would have all the expenses listed. This is just a shortened form. Selling and other expenses have been grouped together too. Notice that the debits and credits equal. We're going to compute the debit ratio and describes its use in analyzing financial condition of a company. The debit ratio evaluates the level of risk. When you are going for a car loan or looking at a mortgage, they're going to look at your debt ratio. Total liabilities divided by total assets. We are trying to determine the company's ability to pay its debts using this debt ratio. A higher ratio indicates that there is a greater possibility the company will not be able to pay its debts in future. How many liabilities do I have in terms to how much assets I carry? Skechers numbers are shown. Debt ratio ranges from a low of 0.30 to a high of 0.33. Its ratio is lower than industry norm, because here's the industry norm for shoe stores, and here is Skechers' debt ratio. It suggests a lower than average risk from financial leverage. If Skechers is making more money with its debt than paying its lenders, then it's successfully borrowing money to make more money. A company use of debt can quickly turn unprofitable if its return from that money drops below the rate it is paying lender. This is the end of the Chapter 2 lecture series. Thank you for watching.